Hey, everybody, welcome back to Military Family Investing. Back for another one. Today, dividend ETFs versus index funds. All right, so both of these you can buy on like an app like Stash App or Cash App or in One Finance. So they're very easy to buy. You can dollar cost average, you can buy fractional shares. But which one's best for you? Okay, which one offers you what the plan of where you need to go? Okay, so there we go. I'll leave the link in below. Take a look at the article. Okay, you're going to have to read multiple articles just so you understand the difference between the two. Okay, grab the book because it's a nice looking book. Okay, so the first plan, the first goal you have to decide is why are you investing? All right, most people who start investing, they invest to build a mountain of money. Okay, the mountain doesn't pay them. So they put all their money in a 401k or a Roth IRA, and it just grows. It grows. It grows to a big number. Okay. So we use index funds for that mostly. Now, at the end of that, once you are 66, 65, whatever you are, and you have 500,000 million dollars, all right, the plan for index funds is to sell your index funds each year to fund your lifestyle. Okay. That may or may not be advantageous depending on the market. If you're in a bull market and the stock market's high, you can sell one share and live off the whole year, right? Um, Probably a month. But if you're not, if you're in a down market, you might have to sell two, three shares. End of the day is each year you'll have less shares. That doesn't sound too appealing for me. Okay. Now, for dividend ETFs, it's a little different. You're going to put your money in, it might not grow as fast. However, it's paying you. So the yield might be 3 or 4%. So if you do get to $1 million, it might take a lot longer. It might take extra couple years to get to $1 million, but it's going to pay you $40,000 in dividends. Okay. And if you reinvest just a little bit, 10%, 15%, just a little bit you reinvest, each year you have more shares than the year behind the next year. Okay. So you're growing your portfolio in retirement. You're becoming wealthier. Now, which way sounds best for you? Okay. So we know what index funds are. Index funds track the different indexes, which are Dow Jones, NASDAQ 100, S&P 500, and the overall stock market, which is my favorite, VTI. Okay. Now, dividend ETFs only track the dividend payers. So that means that the it's not as, I guess, high flying, flamboyant, right? Because you don't have Tesla, you don't have Amazon, you don't have Google in your index in your dividend ETFs, but you have Verizon, AT&T, Johnson and Johnson, Procter Gamble, these type, right? So the highs don't go as high, but the lows don't go as low. It's more of a steady, consistent, because you're buying into companies that have been paying dividends for years. Okay, and there's different types of dividend ETFs. You can focus on high yielding ETFs that are more like Alteria, AT&T, right? Philip Morrison, companies that have over 5% yields, or you can focus on lower flying like Visa and MasterCard, which are less than 1%. Microsoft, Apple, they're all less than 1% dividend yields, but they're going to give you growth. So you can look into it and pick the ones or pick multiple ones. Okay. I give some of my examples inside here of the dividend ETFs. Now, can you use both? Yes, I use both. Why? I don't plan on selling my ETFs in retirement. I'm using them as a growth vehicle for my kids and everything else. So if I do have, say, 300,000 in ETFs and index funds, my kids can leverage against it, right? They can maybe take a loan against it or use it as collateral to buy a house or whatever, right? So it's more like it's almost like collecting a gold bar, right? You sit there, it's growing your wealth. People can look at it, say, oh, okay, as a backup plan. Okay, so you go into the bank, you have $300,000 in ETFs, index funds, and then you're like, hey, if something happens with this $100,000 loan, I'll just liquidate some of these assets, give them to you. Okay, and I do have dividend ETFs for the dividends, right? And I'm an income investor, which doesn't focus on growth. Very rarely does it focus on capital appreciation. You're focused on purely income. So when you have dividend ETFs and you stack those with income investing, you do get some growth in your overall portfolio. So it helps. And you get dividend growth as well. Okay. So you kind of have to read the article, kind of decide where you're at, and, put $10 a week in each one. Right. That's easy. On Stash is easy. In One Finance, you can just, set up a pie with a couple index funds and a couple dividend ETFs and just put your $100 a month in there, and it'll spread it out amongst them evenly. So you'll have dividends coming in, and then you'll have growth. Right. So I use them both. I think they're both worthwhile additions. I do love VTI in every portfolio. All 5 of my portfolios, I have VTI everywhere because I do believe it's one of the best things you can buy. And that's the total stock market index fund, because you don't have to guess. If the market's down, buy more. If the market's high flying, buy some other things that you can get some yield, right? But it's very simple and very effective VTI, right? So with that, that's all I have. You kind of have to decide, where you're going with your portfolios. Okay. If you love the concept of blue chip investing, there's something going on. Let me wrap this up. But if you love the concept of blue chip investing and you don't have the time, dividend ETF. All right. With that being said, I guess there's a grass lawnmower going off. I will leave you at that. All right. I'll leave a link to the article in the books. Have a good one. Bye.